Dividends are payments that occur when companies have excessive profits. And the most common form of dividends are called cash dividends, where companies offer their shareholders the excess profits that have been made in a particular period. If the company decides to hold on to the profits and reinvest in its business for expansion, development, or growth, it's called retained earnings. Normally, large, well-known companies will announce dividend payments along with their quarterly results, while others may issue dividends on a semi-annual or annual basis. Now again, most dividends are cash payments that are paid directly to shareholders. The amount shareholders receive will depend on the number of shares they own and the dividend amount announced by the company. Many companies offer dividend reinvestment plans, where instead of receiving cash, investors can opt to automatically buy more stock with the dividend payment. This can prove to be more profitable if we don't need immediate cash and we're looking to build our portfolio long term. While cash dividends are the most common form, companies also engage in buybacks, where they buy stock back to decrease the supply of their stock. This helps shareholders because the decrease in supply tends to increase the price of the stock. Another common practice of companies is offering bonus shares. These shares are offered to current shareholders on the basis of the number of shares they already hold. Even though the bonus shares boost the total number of shares that the company has issued, the value of the company will not change by the new issues. And another important point to understand is, in spite of the increase of the total number of shares outstanding, the ratio of shareholders to shares outstanding will not change. Now, only certain classes of stock are eligible to receive bonus shares in most cases, which is where common stock and preferred stock status comes into play. Finally, we have stock splits. A stock split increases the number of shares issued by the company. However, unlike with bonus shares, the price of the stock is adjusted in such a manner that the market capitalization value, or the total value of all shares outstanding, does not change. So stock splits can be in different ratios, such as 2 shares for 1, 3 shares for 1, 3 shares for 2, etc. And companies usually resort to stock splits when the price of the stock has risen substantially, and they use the stock splits to bring the price back down. For example, if a share is quoted at $50 and the company announces a 2-for-1 stock split, the value of each share will be adjusted to $25 a share because the number of shares outstanding has doubled.